Good morning. It's Mike Lynch with AmeriFirst Financial. It's time for your Monday morning mortgage update for the week of February the 8th. Hope everybody had a great weekend. It was beautiful weather. Okay, so let's dive right into the market. We got a lot of stuff happening. Last week was another flat week of mortgage rates, not much change. We've really seen this trend continue for the last few weeks, but that's not going to continue. We're at a very pivotal time in the market. Many things will be happening in the next 3 weeks that will most likely see a shift in the current rate environment. Interest rates are going up. It's highly unlikely that the rate that you get in 3 weeks is going to be the same rate that was available a year ago. Does this mean rates will skyrocket? No, it doesn't. But it does mean that everyone will be talking about this. News outlets will be reporting this, and there's going to be a lot of misinformation. Buyers and sellers need our help to understand what this all means. And it's important that we are the ones that are the source of that information. Panic, freezing on what to do, assuming it's the worst, is what I typically see when these rates go up with the consumers, with buyers and sellers. And so what do? We need to connect with our database. We need to talk to our leads, our buyers and our sellers, and really educate them on what's happening, what's going to happen. Now, we have some amazing tools that can give your buyers and sellers some insight about what this changing environment is going to mean and how they can navigate it. All my contact information is down below, as you know. Give me a call, shoot me an email, and I'll be more than happy to share some of these tools with you that can really put you at the front edge and be very proactive with the buyers so that you're being proactive, you're responding, not reacting after it's already happened. So let's talk about what we're looking at this week. What could and could not affect rates this week? Stimulus, inflation, and a treasury dump. So stimulus. The House and the Senate have been talking about passing this $1.9 trillion stimulus package for quite some time. The Republicans wanted a down version of that, less than $1 billion. So what the House did, instead of working with the Republicans, they just passed a budget. They don't need approval to do that from the Republicans. It's a $1.9 trillion budget. There are no details in this budget. They'll figure all that out in committee. But in essence, this is what the stimulus is going to look like. So the big question is, when will people get their $1,400? And we've been talking about that really happening at the end of February, 1st of March. So if there's any news coming out this week that is going to give some insight on when that check's going to come or when the relief's going to happen, that could put rates higher and money shifting to that stock market. So the second thing is inflation. Inflation is the death of rates. If it costs more to buy milk and bread, you're going to see mortgage rates go up. And a report coming out this week, Consumer Price Index, CPI, is a key measure of inflation. We'll be watching that, seeing if there's any insight that inflation is going to go up. And then the third thing is a treasury dump. So what do I mean by this? The Fed auctions off treasuries on a monthly basis. They sell bonds to investors to put money in the bond market. When money goes into the bond market, mortgage rates go down. And they do this on a regular basis. Well, this week, we've got a 10-year and a 30-year treasury auction. It's the largest ever, over $1 billion. And why is this important? Well, our dollar, the US dollar, has been weakening over the past year and longer than that. And if it continues to weaken, then our products and goods become more attractive to foreign economies, foreign buyers, because in essence, people around the world can buy our stuff cheaper. Well, foreign economies, foreign countries don't want that. They want to sell their own stuff. And so one way to devalue the US dollar or to slow the devaluation of the US dollar is to buy US Treasury bonds. So if there's a large foreign demand and a large purchase of these Treasury bonds, that's really good for mortgage rates. We could see those rates go down. So we'll be watching that very closely. The 30-year auction is on Thursday. So not a lot of economic news coming out this week. We actually expect it to be a moderately volatile week as far as rates. So we're going to start the week floating. But again, let's not remember, we've got about 3 weeks or so where we're going to start to see this shift. Please let me know if you want me to share some of those tools with you, walk you through some of the things that you can share with your buyers and sellers that can help you be the source of the information that is going to be coming out. All my information is down below. If you know somebody that could benefit from this video, please forward it to them. If you have any comments, I'd love to hear them. And hope you have a really productive week, and we'll talk to you next week. Bye-bye.